Now, in his June 11th budget speech, the National Treasury Cabinet Secretary Ukur Yatani proposed the regulation of private equity funds by the Capital Markets Authority. Stakeholders in the private equity space now say there is need for clarity as to what exactly the CMA will be regulating and how regulation will spur further market growth. Julian Mboko with more.
In the year 2015, the investment guidelines under the retirement benefits regulations were amended to allow pension schemes to invest up to 10% of their assets in private equity funds and venture capital funds licensed by the Capital Markets Authority. However, the Capital Markets Act was not amended to provide for regulations of this private equity and the venture capital. In this regard, I have proposed amendment to the Capital Markets Act to provide for the regulation of private equity and venture capital companies by the authority.
The private equity space has in the recent past been responsible for a number of capital raising efforts in the country, including the acquisition of a minority stake in Naivas by a consortium of investors and the buyout of restaurants Java and Art Cafe. The East African Venture Capital Association, EAVCA, says there is need for greater clarity as to what exactly the Capital Markets Authority will be regulating should the proposal by the National Treasury sail through the National Assembly.
How are you regulating a private treaty between Naivas and Ametis, for example? How do you regulate that? Are you now opening up your ambit to enter into, for example, family businesses? A lot of PE money is going into family businesses, and some of those family businesses want to remain private.
The EAVCA further argues that the fact that PE funds in Kenya are largely driven by foreign capital is bound to present a challenge as far as the quest for regulation is concerned.
We need to ask ourselves, how is PE regulated in Vietnam, for example? How does it work there? And you might find some level of regulation there, but that regulation that is there is aimed towards money from that particular market.
The association also sees a risk in duplication of regulatory efforts, given that locals investing in private equity largely do so through pension funds.
That's why we have got RBA there, Retirement Benefits Authority, regulates pension funds. So now, what will be CMA regulating? The other end, which is when we are exiting, or when the pension funds are investing, that's regulated already by the RBA.
Kenya has been the sweet spot of attracting private equity and venture capital funds into the East African region. Many are now concerned that regulation, if not well thought through, could undermine the country's position. Julian Mboko, NTV.